not just the money that you make in the company in revenue. It's not even just the gross profit or the operating profit. What are some of the most important financial metrics you need to be looking and paying attention to? How do we make sure we maximize your after-tax? What can you pull from that, both to run your business more profitably, to have a more successful exit should you decide to sell your company?
Maui Mastermind presents the Business Coach Podcast, answering your questions and providing real actionable insights for building a better, stronger, more profitable business without sacrificing your time, life, or freedom anymore.
Well, welcome to another episode of The Business Coach. I'm your host, David Finkel, and I have a special session in store for you. I brought in my very good friend, Kevin Bassett, CPA and tax strategist, probably one of the nation's leading tax strategists, working with small and mid-sized business owners. He's incredibly good. He works with high net and ultra high net worth individuals, business owners, etc., private equity companies. And Kevin and I are going to be getting into things about how you as a business owner can look at your business and what are some of the most important financial metrics you need to be looking and paying attention to. We're going to look at what's your labor burden rate. We're going to look at your margins that are in there. We're also going to talk about how can you pay yourself tax efficiently. So it's not just the money that you make in the company in revenue. It's not even just the gross profit or the operating profit from the business, but it's the what's left over, the net profit after tax. And he's going to talk about how to do that tax efficiently. We're also going to get into about what are some of the most important tax considerations when you're selling your company. You know, Kevin's helped many clients sell their companies. I know this firsthand simply because we have shared clients. He's worked with many of the Maui coaching clients, helping them from an accounting perspective and the tax strategy perspective when they go to sell their company. We've been helping them on the business coaching front, and they've had some significant exits from that part. How do we make sure we maximize your after-tax value, your after-tax profit when you sell a company? And then the final part of the interview, I talk with him about, well, should we even sell our companies? And we talk in there a real world conversation about the ins and outs, the pluses and minuses of selling your company. And both Kevin and I revealed that neither of us has any intention of selling our company, at least for the next decade or more, and why that is, even though both of us are in our 50s now and could financially retire, but neither of us have plans to, and we'll share why that is. Kevin is somebody who I really respect. His CPA firm, Bassett & Associates, not only works with many of our clients, helping them save hundreds of thousands of dollars or millions of dollars over their life cycle in terms of taxes, but most importantly, for any firm that does tax strategy, they do a lot of audit defense. So they see what works in the real world. The biggest reason why I really enjoy having Kevin on here is just a good guy. He's a good human being and someone I really admire. He's one of the people that I look up to when I think. So let's take a look at your business from the eyes and through the viewpoint of someone who's got real financial savvy and sophistication. And what can you pull from that, both to run your business more profitably and to have a more successful exit should you decide to sell your company. All right, here we go, Mr. Kevin Bassett. Well, Kevin, welcome to the Business Coach. How are you doing today?
Doing great. How are you doing, David?
Wonderful. Now, you
Great.
are in North Carolina today, or are you traveling?
I'm in North Carolina. Yep.
All right. And I love it. You got the man in the arena behind you. That's a great quote.
Yep. Love it. Got to be in the arena. Get on the field, not on the sidelines. So.
That's right. I know you have your Bassettisms for your family. Bassets are on the field, not on the sidelines. I love it.
Exactly right.
So those listeners that don't know, Kevin's got his kids who are now grown women now, but when they were younger, I having conversations about coaching and Coach Kevin coaching softball teams and other parts. But Kevin, the place I want to start today is, look, in the work with your CPA firm, you get to work with hundreds, if not over your career, thousands of different small and mid-sized company business owners, et cetera. And so you've seen a lot of various industries, verticals, business models. What are one or two of the most common ways that you watch a business owner make things harder on themselves? That, I call this a self-inflicted wound. What do you see or notice?
Sure, absolutely. I'll start with one of the most common frustrations that all business owners, if you've been doing it a while, have run into, myself included, and that's when you have a bad team. And sure, there's a little bit of good luck and bad luck, but a lot of it is when we have bad teams, it's self-inflicted because of a few things. One, we may not have a quality hiring process to add folks to our team. And so having a good process, for example, we use top grading after experience a bunch of bad hires. You guys with the Maui community, you have an excellent process for that, and that's important. And then with that process is involves some quality testing. And you got to figure out the tests, and I'm sure it's plural, not one test, but multiple tests that are appropriate for any organization, right? Your organization, and doing that. So, for example, in our business with Bassett and Associates, we use the Colby, the DISC, and then a technical competency test, depending on the position that they're applying for. So whatever the position is, we have a test for that. And that's all these are from learning the hard way. And then finally, once your team members are on board, having a management and HR system to run the team. So number one, the biggest thing that can make things hard in a business as you scale is a bad team. And any of the times that I thought about hanging it up and taking my ball and going home, they were all team-related drama. The other stuff I'm able to handle and be plenty resilient and get through it. That said, now I've been doing it longer. I have the wisdom and experience to recognize when that's the issue, and not worry about washing out. So that's the first thing. Next
Let's
thing
stay
is
with that one.
comment
Let's stay with that one for a second,
Sure,
Kevin. So I
sure.
want to come and pack a few things here. So you're talking here about bad or poor team, and I get that if I look at the things that have caused the most emotional cost in the business, by far it's people.
Yep.
I might have financial cost other place. I make a bad decision or haven't thought something through. But the stuff that's kept me up at night is almost never the money. It's almost always been the people component to it. Are you similar?
Absolutely. Every time, as I look back, every time, even during the recession of 2009, when a lot of us, had to interrupt our own payments or profit distributions as money slowed down. Sure, there was some stress there, but I thought that was a lot easier to handle than some of these, in hindsight would have been smaller team drama issues. But at the time, they were huge. You're magnified times 100. It's just tougher emotionally. Exactly right. And hey, we're human beings, not robots.
Yeah, I mean, when your comment about in retrospect, they seem smaller, but almost always seem larger at the time. So one of the things I watch as a self-inflicted wound, I'm curious if you comment on it, are business owners who hide from reality. And they think that by closing their eyes that they can change the world, but really reality is going to win. And so they'll accept a behavior without addressing it. Or there's a tension somewhere that they just aren't willing to have a conversation about, or they don't set a boundary, or even in the hiring process, they gloss over or finesse something that's a make it or break it in the role. And then later on, it almost always comes back to bite them in the rear. What are your thoughts about that?
Yeah. And it's, so a lot of things, everything you just said was spot on. One, while the folks are here, we're, business owners and anybody, right? We're human beings. We have compassion and empathy, and we're reluctant to rip the Band-Aid off when they need to, because and so we have all done that, right? There's the old saying, hire slow and fire fast. There's things that, my advice would be, anytime that someone is toxic or cancer to the organization, do the right thing and get it out quickly, right? Because it can poison, you can lose some great people. The same is true, less urgent, but equally as important, when you have an underperformer. Your good people don't like that, right? And so there's another saying, right? Nothing builds morale like a good firing. Well, if it's appropriate and right and done compassionately. So anyone that's toxic needs to go, and an underperformer, do a performance improvement plan. But if it's not going to work, right, move on, or your good people will leave. They want excellence. But the hire slow, right? The hiring process, we have all done it. And where you see a red flag during the hiring process. And by the way, with top grading, if you haven't read Brad Smart's book, anybody, Brad Smart, he's got two, the top grading, and I forget the other one. I think it's called Who.
It is. It was called Who. It's a good book.
Yep, excellent. And I've actually, we had such bad hires that I personally went and took the course because I realized it was so strategically important and such a not a blind spot. It became an obvious weakness in our organization. But they looked for patterns of success, right? That's what his process is about, right? You walked literally through their whole career, where they were at, where they getting promoted and raises, et cetera. And then he uses the torque method for checking references. And a lot of I know business owners that absolutely just haven't done the references, or they delegate it to an HR person, which an HR person talking to HR yields nothing, right? Because it's all legalese. But if you get business owner to business owner, you can have a real conversation. But they'll have the red flag, and I have personally done it, and others have, like, oh well, that didn't work out, with that boss. But if they haven't had me yet, the greatest boss in the whole world that can make them successful, and so we do the testing first, and Kevin is not allowed to even meet the person until they've been filtered with the test, because I'm a sales guy, and I'm going to talk about how awesome Bassett and Associates is and what a great place it is to work. And that is a horrible interview technique, as it turns out. So so yeah, red flags. And so this is one of the only areas when I say is about trusting your gut. I heard business owners that they try to explain away they're about to make a horrible investment. Like, oh, my gut says this is going to be great. Well, I don't ever do that. But on the other hand, if your gut says, hey, I don't think this person's going to work out, run, right? That's when you trust the gut, in my opinion.
Yeah.
Yeah.
I like what you said there. And I'll tell you, when I read Who probably 10, 15 years ago, and one of the things I took, I've like you have done lots of hiring over the years, several hundred hires. And when I look back at it, the reference check was probably my big takeaway from Who. I mean, there are lots of things I liked about the book, but I felt like we already by that point had a fairly solid hiring system. But the reference part, one thing I loved about what he did is he talked about when I go talk with, if I'm call up Kevin and say, hey, Kevin, I'm thinking about hiring Sheila. Can I ask you when and she worked for you 2 years ago. Hey, Kevin, no, she said when I talked with you that you would probably have thought that at that time, 2 years ago, that the two or three places that she needed to focus on were X, Y, and Z. Would you agree with her assessment by starting with that negative that Sheila told me to say that you would probably
Yep.
say, now you're much more open to sharing the rest. And I thought that was brilliant. That was worth the 7 hours of reading the book. For me, that one section from that part. But
Yep.
tell me here, you talked about using Kolbe and DISC, which are two personality assessments, and there are various ones,
Absolutely. There's lots. Yep.
How do you use a personality assessment? Like for you, I'm assuming it's not that this is like most people I notice use that as it's going to point out things that you should dig deeper on it. It's going to point out flags that need to be addressed or looked at versus absolute black or white with that. How is it that you found the
Yeah.
most helpful in your best hires using those
Sure.
assessments?
So the particular positions we're hiring for is accountants. So in these cases, those two are black and white for those positions. Now, those tests would not necessarily either be appropriate or not complete enough if, for example, if you were hiring for an outside salesperson or a manager. For management, I would definitely go Omnia profile all day long. And for manager and above, we use that one. And that was a tip from Alan Gassman, one of the greatest things he ever shared with me. For us, the reason Kolbe and DISC and our technical tests actually are black and white is for our positions, we are looking for high follow through. Again, these are specifically accountants. I'm not hiring for salespeople. And by the way, we share these tests with our clients. We give it to them, our entire process, because we want them to have great internal accountants, because that's in everybody's best interest, our clients' best interest, and ours, right? If we're going to do tax planning based on those books. So at Kolbe, we are looking for high follow through, and we're looking for some fact finder. We want that fact finder to be lower than the follow through, because actually what will happen is if they're all fact finder and no follow through, they're going to get caught in the weeds and not actually finish anything. And then the angry elf of Kevin comes out. And then with DISC, we're looking for both high C and steadiness. So in that case, if they don't meet those, ring true on both of those tests, they are not considered for the position at all, right? They do not make it to the interview stage.
Makes perfect sense. So in your world, first of all, DISC, D-I-S-C, D-I-S-C, you can look that up online. Kolbe, K-O-L-B-E. Again, you can find that online. Both are useful personality assessment tools. There are other ones. I like what you're saying is that for the main type of hire that you have, which for you is an accountant,
Yep.
they need to be someone who's going to be able to get work done with an attention to detail and a follow through to complete the tax returns and the other financial accounting work that you've got them doing. That makes good sense.
Yep, absolutely.
What was that second self-inflicted wound? You had two, and I stopped you because I wanted to unpack this first.
Yeah,
one. What
yeah.
was the second one?
No, I have three. And the third one segues into the make it easier. But the second one is bad books, meaning having bad financials. So if they haven't worked on the financial pillar of the business, which takes time, right? When you first start out, that's not going to be top focus. You can do the checkbook method, or what I call the BS method. The bank says I have this much, right? A little bit of planning, just like your home budget, will get you from starting at zero to a few hundred grand of revenue. But as you scale, it's important to invest and upgrade the financial pillar. And your program does a great job on focusing on that, right? You have financial pillar super course. You have an event every single year on this, right? Because it is so important. So having bad books, and that means inaccurate and or, right? They usually go hand in hand, not on time, not timely. And if you do that, you're flying blind. And if they're really bad books, which I've seen, then you're actually flying blind and with bad information, right? So you're looking out the rearview mirror, and it's somebody else's car, right? So the really upgrading and having a high quality internal team and or external, right? If you can outsource it to your CPA. We do a method called collaborative bookkeeping, where they'll keep day-to-day transactions, and then we'll come in and do the month end tie down, because I'm seeing a trend out there, and QuickBooks has exacerbated this because a lot of small businesses start with QuickBooks and they don't upgrade to a NetSuite or a Sage until many million later, right? And you can go on QuickBooks a long time if you've got somebody decent running it. But the pros and cons of QuickBooks is, right, anybody can go in there and pay some bills, even if they haven't had 5 minutes of an accounting class. So a common thing is they'll have someone in there that is simply has not been trained or is incapable of tying down the balance sheet. And the little trick that we learned the first day of accounting class in high school or college is, if all financial statements are the difference between the beginning and the ending balance sheet, and if either of those are wrong, it is mathematically impossible for your profit and loss to be correct, right? Which a lot of times a business owner is mainly looking at the profit and loss, right? And because that's what they know. But it cannot possibly be mathematically correct if the beginning and ending balance sheets are incorrect.
Let's riff on this for a moment here. This idea of having the financial. So the business coach in me comes out, and having looked at a number of clients' financials over the years, what I notice are a couple things. Like, first of all, how do I use my financials to spot profit opportunities? I'm looking at Acme Inc., and Acme Inc. had revenue went up by 26% this quarter. Wonderful. Mm-hmm. And then so I'll take a look at their gross profit margin. I'll take a look at their expenses. I'll take a look at their below the line operating profit, and I'll see what percent did they go up. And what I want to see is, did my gross profit go up by at least 26%, which is to match the revenue, and ideally even more because I've got some efficiencies. And so if I notice that number didn't go up as fast as revenue, now I can spot, did I over order materials? Did all of a sudden I started having scope creep with my production? Other parts with that. So that's one place that I'll use as a clue to look and use the financials to spot opportunities to increase profitability. What jumps for you for things like this?
Yeah, absolutely. When it starts with, it's got to be right. And but yeah, and do that with financials. We do a thing, and this segues into what makes life easier. If you got great financials, then the technique we use with our clients is manage by margin. And if you manage by margin, then you can't help but scale profitably, because we're as you scale, grow revenue. If you're maintaining and or improving your margins, then more and more pennies on the dollar drop to the bottom line as you scale, right? Yeah. So as opposed to someone that just is focused on revenue, but they're actually diluting their profitability, and you're working harder and have a lot more activity running through, but you're less profitable, you're taking less home. And oh, by the way, you screwed up your valuation. Now your business is worth less.
Yeah. Define for us here. So if someone's listening or watching this, Kevin, they don't know, like I'm assuming the two margins you're looking at most are going to be the gross profit margin and then their equivalent of their operating profit margin, whether using net income or other. Define, if you would, gross profit margin and operating profit margin, just so a listener who doesn't have fluency with that can hear it from you as a CPA.
Yep, absolutely. So gross profit margin is your revenue minus your direct cost to deliver that product or service. Now, it is most important for a product company, and I'll get back to that on latest trends with service companies, which is interesting. The second margin you mentioned is operating margin, and this one has a few different names. Also, can be referred to as adjusted EBITDA margin or seller's discretionary earnings. And what we're looking at there is what is the profit the business is generating before the business owner takes a dime, right? Before they get paid anything. Because how the business owner is paid, if your CPA is any good, is actually a tax decision, right? And so we're looking at that margin first because that's what your business is worth. That is the earnings that you're going to be selling eventually to somebody. And most of our clients, we sell to private equity. So we're real dialed in on how they look at it. So that operating margin. And then how we pay it, there's going to be some wages. There's going to be the pre-tax in your lifestyle. We call these sellers discretionary expenses or grateful expenses, things that you can legally deduct. And then some other tax tricks. We might be shifting some to other entities, a management company or an IC disc. Those are tax decisions. Those are below the line. So you mentioned the first two, gross profit margin and operating margin. And then the third one we look at, which is really crucial, particularly in a tight labor market, and that's the labor margin. And with a service company, the latest trends over the last decade plus is you're looking at all-in labor, less about how much is direct labor and whatever, because they're finding a bunch of studies came out with Bain and McKinsey and some others that service companies that run with phenomenal admin support and focus on that actually are much more profitable than those that don't. So what happened if you just focused on direct labor as a service company, particularly professional services, you may be actually missing the boat. You're underinvesting on your admin team. And that's true. And since we switched to that, our margins have gone from 32% to 46% by looking at it. So I actually do not measure, I don't have direct labor in cost of goods anymore. I look at all in labor margin, soup to nuts.
And as it makes sense. What you're saying is that direct labor would be your CPAs who are doing the actual tax preparation, et cetera. Mm-hmm. But if you can have admin that make your CPAs 20% more efficient, 50% more efficient, 100% more efficient.
Exactly the number, in fact. Yep.
There we go. I like the idea. We'll talk about that in our world of creating your expert system, such that what needs to be done by the brain surgeon and what can we push down to the surgical tech and what can we push down to the medical assistant who comes in afterwards to clean up the room and get it ready for the next part. I love that.
The same is true. And actually the medical profession helped pioneer this because that's the advent of MA and mid-levels versus MD. And then they did it. And then law firms, CPA firms, engineering firms, and consulting firms followed suit. Yeah. And that's where these new things, the client concierge and client service coordinators, these things came out. And sure enough, so we were able to more than double our revenue with the same number of billable accountants simply by redesigning our admin team. So had I only been focused on, what's direct and what's admin labor percentages, that would have been, it was flawed thinking that I used to do, right? A lot of us did.
So. I'm curious, Kevin. So we need our financials to be three things. They need to be accurate, they need to be timely, and they need to be meaningful, right? So I'm curious on the timely part. We've got clients that start with us and we'll ask them for financials. And they'll say, oh, here's my financials. We're talking in June. They're only current through the end of January. They're 4 months behind with the financials. And when we dig into it, here's what I commonly hear. Like the number one culprit I hear as a business coach, you probably hear it differently. At first, there's a little bit of embarrassment. They don't want to talk about it. They tell me, oh, I'll get those to you, but they don't. And after I hold them accountable and say, hey, you need to do this, right? This is what you committed to, and this is why it matters. What I usually hear is that their accountant or their bookkeeper or their controller is waiting on their credit card statements, and they haven't gotten their credit card statements. And I almost invariably say, why in the, two things. Have them put all the credit card stuff into an uncategorized at the absolute worst case scenario, or, have the credit card statements come in, after the owner can get them for sure, but have a copy go over to the bookkeeper controller. And yes, they're going to miscategorize stuff, but at least you won't be 4 months out on your financials. I'm curious because this must be even worse for you, I'm sure.
Yeah, no doubt. Yeah, so right, find a home, park it in QuickBooks. They create an account called Ask My Accountant. Fine, park it there, right? You know where to go. And Sage, they use uncategorized, and then Thompson, they use something called Suspense or something. I don't care, right? Find a home and park it. And then, what we do if a client's going to come on and be collaborative bookkeeping, we get read-only access of the bank and credit cards. The same thing, categorize what we have. One cool thing with QuickBooks Online is they let you set up bank rules. Some they'll try to find a home for the transaction and classify what they can and park what they can't. So yeah, have a system and find a home and then spend some time clearing these unclassifieds, but at least get something out and fine. So you've got 10 grand sitting in Ask My Accountant. At least you have an idea what your margins is. You spend it on something, right? And it wasn't labor. It's probably not labor, right? So you can still manage your main margins and like I said, a service company, you really just need to watch revenue and labor margin, right? If you do those two, you are 90% of the way there. Yep.
Hearing you say that, it's funny. So I'll often tell the client, and I'll say to my coaching client, say, look, your bookkeeper wants to be perfect. Let's look at this. You're not
Mm-hmm.
getting your financials for a month or two or three because you haven't gone through your credit card statement, but we're looking at, you might have $500,000 of monthly revenue, and you're looking and you're holding up your financials for $5,000 worth of credit card expenses,
Right. That's
of
right.
which it's one charge for 4,000 that you could just tell her, and then you have 74 charges that total $1,000. Why would you let yourself allow that behavior? So I will usually give this rule of thumb. I'm curious to hear what you think about it. Like, look, you should have the expectation with your controller or whoever that they're going to close your financials no later than the 20th of the following month.
Yeah, that's perfectly reasonable. And hey, you can get it to the 15th or 10th, awesome. We try to have all our billing done by the 5th, which means our books aren't done until the 7th, right? So, and we're a CPA, and we've got one client that they do it by the 5th. Cool, they're better than us. But yeah, do it, and as part of the monthly packet, have that list of unclassifieds. But the excuses are fun. I have this one guy, it was clients for years, till he's since sold his business. His name was Harry, and he'd call every year, and we're trying to get a tax return out, which by the way is not why you keep your books. You keep your books to run your company, not to for a CPA to put some numbers in boxes. That's all a tax form is. And he'd call every year, and it was so funny. He's like, "Hey man, a bug got into my computer and ate my QuickBooks, man. I don't know what happened." I go, "You mean you just haven't done your books yet?" "Yeah, man, sorry." And every year, and was like,
I mean, that's the business owner. The dog ate my homework. I'm
yeah,
laughing.
literally, a bug got into my computer and ate my QuickBooks. I loved the call. I expected it. It was fun.
And I'll just mention as a CPA in your world and in my world as a business coach, I never get upset with somebody who has financials that are messed up. I look at that and say, look, you're making $380,000 of profit this past year with messed up financials. We can help you make 500,000 over the
Yep,
next year or two if we
like
have better
that.
financials.
Yep, in a minute, right? And that's just it. And yeah, so having the system and manage by margin, then teach them how to, hey, just watch these numbers. It's not that hard. It's really cool. But you got to have good books.
I
And
love
and
it.
I'm in it and this is me talking as a business owner, not a CPA. I'm in my books at least 3 days a week. Right? Like I've got my screens exactly what I'm looking at. I know I can tell you to the day how we're doing. And just having that information, life is so much easier, right? That's it. I have an accountant, right? And I'm a CPA.
There we go. And at the minimum, I should be in there monthly. I should be looking at the previous period comparison of my balance sheet. I should be looking
Mm-hmm.
at my P&L at a minimum. And I should probably, depending on the business, be looking at my aged AR report of some sort to see at a minimum. And then over time, your comment about the labor margin is an interesting one for me on the service business. I love the idea that if we're not careful, the cost of goods sold in a service business doesn't help us because of the other ways of boosting profitability, the bottom line
Mm-hmm.
operating margin through the use of technology and or support staff in this case. And you're talking about
That's right.
admins or in a medical, your MAs and your physician assistants or your nurse practitioners. I love that. That's great.
Yep. Yeah, and just remember, right? Labor and the original definition John Baptiste say of entrepreneurship is taking resources from one level and taking it to reselling it at a higher level. And in service business, it's labor. Not that you're billing by the hour. We're not saying that. So our whole puzzle that the entrepreneurs, the business owners of a service business have to solve is how do we get a higher yield on our labor, higher revenue per labor. And so really we just have to watch two numbers. It can't get any easier. And
I was
don't
talking with a woman, Kevin, who's the niece of a very dear friend of mine, and she's starting her first business. I know typically in the business coach, we're deal with people who already have existing profitable companies, but I gave her one part which was on pricing. I said, look, you're a service business at this stage. Whatever your cost of producing your service, just multiply it by 3 as a starting point. And as you get better, then multiply it by 4 or 5. See, how could you add enough value that you could actually have that marked up 4 or 5x with that part? And generally, you'll be okay with that.
Yep.
What would you say to someone who had less of a white collar service business, but maybe had a blue collar service business? Would there be something that you would tweak or adjust in terms of managing by
Yeah, well,
market?
you do start with a 3 in blue collar, right? White collar is 4. But the thing with the 3, and I was just teaching at an event, and this came up, which were blue collar service businesses. The 3 they were using was the base rate, not the all-in labor margin. And it was like literally I taking sunglasses off their eyes. They're like, oh my gosh, that explains. And that was the gap in their margins they were missing. But it's 3x all in on a blue collar business.
I love it. So
Yeah.
I'm going to pick your brain here right now. So imagine I'm a construction owner and you're giving me some coaching here. I own a construction or a contracting business for me. And if I'm going to price a job at $100,000, what's the gross profit margin I should be aiming for? That might mean I have to price higher or lower depending on what my.
Yeah. So on a contractor, it depends on the trade. Your high margin trades, which are going to be windows and things like that, not roofing, but windows. So you should be at 50% is your gross profit margin. But the key is you got to have materials and labor. And in that labor, you've got to make sure you're including payroll taxes, workers' comp insurance, and general liability. In that particular industry, comp and liability is huge. With my workers' comp policy is $850 a year. It's irrelevant. It's a rounding error, right? If we wouldn't notice it. But with contractor, their comp and liability is huge. So they've got to get that in, and they should be at 50% before sales commission. Then, of course, you got to manage your sales position. Hopefully, it's down at 8% or less. And then roofing and home building is going to be a bit different. But no one, home building, for example, is probably in the mid-teens. And to that point, I had a home builder that I got their books. They had turnover in the bookkeeping thing, and his margins were above 20. And I was like, no way. And I called him and I looked at his books, and he had all this accounts receivable. And so what happened? A home builder shouldn't have receivables. They get paid at closing. What happened? His revenue was duplicated, and he was about to pay tax on 800,000, but his real taxable income was, about $500,000. So, was able to just understanding the books.
Yeah.
And of course, he didn't look at his balance sheet. Same thing.
So just one last comment on this one. We have a client that was in a bit of a financial jam, construction company. They didn't do home, they did remodels, fairly extensive remodels. And I talked with them and I said, tell me here, what is your target when you're pricing a job? What's your target gross profit? And they say, well, we target between 20 and 25% gross profit, knowing we're going to lose X and Y. And I said, okay, it's interesting. I gave them an exercise to go back and look at the jobs they had done over the last 2 years, and their actual gross profit margin was somewhere between 10 and 12, 14% at the best, fluctuating on jobs. And I'm saying, well, what you're not noticing is you're getting killed on scope creep, and you're getting killed on scope creep, not just from doing extra work, but you're putting in extra materials where you're not, from change orders, et cetera, and you're not billing for it. And this is where it is. I mean, this is your profit right there. Even if you were to maintain that 20% or an 18%, that differential is hundreds of thousands of dollars that would be your profit. And that's why you're not writing yourself a check this month or last month or the month before. So
100%
this stuff matters.
Right. Yeah, and contractors, if you have jobs like that, I was on with one yesterday, and their books aren't perfect, so they're a little slow on that. The one thing they were doing well is TQM, where they're looking at total quality management and going over the job costs job by job individually. And thank goodness, if contractors do those two things, they can be super profitable. You're exactly right. The two big things are scope creep and not billing for change orders, right, in construction.
Yeah.
Yep.
So let's put your tax hat on for a moment. If we're going to talk with one of the best tax strategists that I know, then I'm going to ask some tax advice here. So, for a business owner, give us some insight, Kevin, some of your top insight of how can we pay ourselves tax efficiently. Share with us on that.
Yep. All right. And I'll first start out with a few non-tax things. So this is a tax guy saying this, but as a business owner, focus on write-ons, make a ton of money first. We're not going to talk right now about how we're going to drive down taxable income and spend all our money so we don't pay any tax. So that's first thing. And then to get right on, make a ton of money, make sure you as the business owner are managing your time well. That's the final thing to make things a lot easier. All right, so you're doing that. You're making a ton of money. And I mean, go make millions, folks. If you're going to put in the time, make a ton of money. But the way to take more home and as a couple things. First, start with the proper structure. And if this is the business that's feeding your family, it's probably an S corporation. All right. And then the next thing, so with an S corp, we're only going to have one layer of tax. We're going to get rid of self-employment tax and Obamacare tax. So now the next key is we've got our S corp. We're making tons of money, run a lot of profit through. We're going to take it home in a few different ways. First, we do have to pay ourselves a reasonable salary. Most likely, you do not need that to be more than 100 to 120 grand, unless you're going to use an advanced retirement plan. So that's the first thing. The second thing is we're going to pre-tax our lifestyle. And that's a technique we use where certain expenses that we're already paying by living in a first world country, these things are now actually deductible simply because we're a business owner, right? They're in the Internal Revenue Code and we're allowed to take them as ordinary and necessary business expenses. So that's things like our vehicle, our cell phone, our home internet, some sort of recapturing some of our home costs through home office deduction or Augusta rule, right? And these things, if we can pre-tax them, then some of our travel, even some of our meals, if we can make them business related, right? You got to eat 3 meals a day, right? Some of those meals during the week could become deductible. And so if we're pre-taxing our lifestyle and then other benefits like our insurances and whatnot, that's money that we're actually taking out completely tax-free, right? Getting paid on our behalf. And then the rest of the money, until our income is above 600 grand, personal income, we're going to be able to take out as S distributions. And those S distributions, which are like dividends, are very tax efficient because there's no payroll tax, no self-employment tax, no Obamacare tax. And for most industries, they're also going to be eligible for what's called a 199A deduction, where 20% of that money is actually tax-free, right? That profit that flows through to us. So that's getting paid super efficiently. And you hear the term about how Warren Buffett's talking about that his secretary pays a higher tax rate than him. Well, that's actually true, and and that statement's gotten political and all that. I don't get into politics, but as a tax planner, that's exactly right. As a business owner, if you set up your compensation correctly, you should have the lowest tax rate of almost anyone in your office, right? When you add in all the taxes, so that's going super tax efficient.
I love it. I love it. So let's go to the end game. Fast forward here, and for many business owners, their end game for many of our listeners is going to be to sell a company. So what are some of the tax strategies that you would use with a client to generate the best after-tax sale result versus pre-tax sale result?
Yep. Okay. So a number of things here to unpack. So number one, selling your company, this needs to be very intentional that you have started at least 4 years earlier. And here's why. When you sell, and our superpower in our firm is getting companies profiled and attractive to private equity. So we want to do a couple of things there. We're going to get their adjusted EBITDA or their operating income above $1 million, right? That opens up the audience to a lot of private equity firms. So I recommend that to everybody. And so not only is that a bigger number, earnings number you're selling, you're going to get a higher multiple on that. And you got to have great books, right? What the private equity firms are looking for is an ATM machine that is consistently kicking out monthly income. Your book's got to be great because they're going to go through a process called financial due diligence. And then they're going to do a thing that almost all sales now are happening. It used to be only on the big companies, but it's called a quality of earnings report. And you got to be ready for it, right? You got to have clear numbers. And I'll tell you one thing, don't pull this year-end spend down where December you're clearing the desk of all your bills to try to knock down earnings. You may have saved 30 cents on the dollar in tax, but you may have just cost yourself 5x, right? So if you paid 50 grand in bills to try to save, 15, 20 grand of tax, but it cost you $250,000 of valuation. Terrible idea. So, and then, so besides getting the valuation up, that's the first part of getting a good after-tax sale. The second thing is have a plan on what you want to do with the money, because that's going to determine, right, are we going to make this a non-taxable sale or a taxable sale? So if the goal is to take the money home and live on it, pay some stuff off, fund a few things, buy a few things, and live for retirement, it may actually make sense to do a taxable sale, which I'll get to in a second. If that's not the case, if you just want annuity for life, or you want it to go to charity or some sort of a legacy planning, it might be appropriate for a non-taxable sale. But all this has to be planned for way in advance. So if you want to do a charitable remainder trust or some other trust structure. But let's assume for a minute we're going to do a taxable sale because we're going to take it home. 9 times out of 10, it will probably be an asset sale. Okay, so of all the sales we do during the year, we may only have a couple that are stock sales. We've got one going on now. And so we want to position ourselves, do a strategy the year before you sell called recapture minimization. And the reason we do that, when you do sell in an asset sale, some of those assets are going to get taxed at ordinary income. So we want to minimize that. It's because of a concept called depreciation recapture. So we'll do recapture minimization. The idea being that if we do a taxable asset sale, we want the majority of that sales price, the profit, to be taxed at long-term capital gains rate. The other cool thing you can do with an asset sale of an S Corp is there's an election you can make, and most CPAs miss this, but filing under the regs, and you can actually avoid the Obamacare tax. It's also known as the net investment income tax on that sale of an S Corp, right? So you save another 3.8% there. So you can actually get a true federal rate of 20%. So that's one way. With our larger clients, we also may have what's called a hybrid structure, where we've got some of that business, the intellectual property or something else inside a C Corp. And that portion may be tax-free under Section 1202. So the whole point of what I'm saying here is not to turn you into a tax expert. It's just to recognize that planning financially and tax-wise for a business sale is something that should happen years in advance. That said, every year I've got some client that emails me a signed letter of intent that they just signed with the first person, that ever made an offer on their business. They didn't get competing offers, nothing, and they signed the darn thing, and then they want to know what they can do tax planning wise. And of course, the answer is nothing, you idiot.
Right. So, right. Next time, talk with us first. Yeah. I think that's great. That's really important advice I'm hearing from you about, hey, how do we get the valuation higher? And you made some good comments starting at that period 4 years prior. And then in terms of how we're going to characterize what is we want out of it? Are we looking just for a lifetime of income? A charitable remainder trust strategy might be better. Are we going to donate the money to charity anyways, or a large portion of it? Are we going to put some of that way? Are we looking at what can we do on an asset sale to have as much as possible that be taxed at long-term capital gains versus being taxed at ordinary income? That's good stuff. Just a different one. You and I had this conversation a while back, and as I shared in the introduction, Kevin, that the listeners know and viewers know, you happen to be a good friend of mine and someone I care about, and we were having this really interesting conversation about should we even sell at all, and maybe for us owning the business longer, and tell us about how you look at this in your perspective. I'm really be curious because you work with lots of clients after they've sold their businesses and pay close attention to that. Share if you would on that.
Yep, and absolutely. And those that have worked with me and sold a business, and believe me, I love taking our clients to the finish line. They've had a nice long entrepreneurial career, and we sell it for piles of money, life-changing money, and they're done. But every one of them knows, right? When they come, those that were smart enough to come to me before they sign the LOI, I go through some questions with them. And these are things I've learned from other advisors in the field. One is I'm really probing, are you really ready? Do you really want to sell? Or is it that hey, you just love the attention of getting the overtures, right? Near tax season, I counted in a 10-day period, I got 8 overtures from private equity firms wanting to buy Bassett and Associates. So not interested, right? But if they'd have caught me years ago when I was having team issues, I might have written them a check to take it, right? But no way. So a lot of one of the most tragic things I see is business owners selling before they are ready. And the reason I use that word tragic very intentionally is when they're not ready, what they've lost is their passion, their vocation, and in some cases, their identity, good or bad. And they didn't have their what's next. All right. And they still had unfinished business with that business. And the divorce rate is very high. The mortality rate is very high post this. They don't have a what's next. They start the dying process. And sometimes they're lost. I had a good buddy of mine sell in 2021 when there was this craze. He's exactly my age. Sold to private equity. I asked him, he's like, oh, yeah, yeah, no, this will be great. And when you sell to private equity, they pay you a lot of money, bless you. And but now suddenly you're answering to somebody else. Now, there's usually a reason, I think there's two groups of people in the world, those that sign the front of a paycheck and those that sign the back of a paycheck, right? Business owners, we sign the front. We're on our own usually for a reason, right? And me, if I'm going to start, answering to a 26-year-old MBA who has never had to cover payroll or run their own business, I think I'd last till about lunchtime on Tuesday. Right. And that's what happened with this guy. And it got to the point where they didn't even let him in his own building. Right. And he was miserable. And, said, even though it was walk away money, he's like, biggest mistake of my life, or his exact words. And he said it repeatedly. So that's the first thing. Make sure you're ready. Because there is the alternative. If you got a super profitable company that's cranking out 7 digits of profit, man, that's a lot of fun to own. Because at that point, you probably have the systems in place. And that's kind of where I'm at. Like, let's just keep growing this thing and running up the score. Because it is a heck of a lot of fun, particularly if you've got your time managed in such a way that you're doing what you want to do now. You don't have to wait till you sell a company to do what you want to do. Or if you're making 7 digits, do it now, right? And so that's the first thing. Make sure you're ready. And sure enough, divorce rate is high. I've talked to some business owners, and yep, that's what happened. If they're not ready. On the other hand, if you are ready with some good planning, fantastic. What a great outcome.
Yeah. My observation coaching clients who've sold that generally speaking, most of them are going to go on to do something else, not all. And, just a couple coaching tips in there. If you're going to do that, if you're thinking about doing something in that same industry, fight back on the non-compete duration and the scope of it. I've got a client who did a 5-year non-compete that was written so broadly that really can't do anywhere. I mean, he can't be within, I think it was 20 miles of another location for a private equity roll-up group that makes
Yep.
it really hard for him. If he had done 3 years, or which I think he probably could have got them to accept, he would be right about a year away from doing something fun again that he would want to. And then I guess my last comment here on this is, I agree with you. I watch people who realize that when they've sold the company, they've lost a certain sense of relevance to their activity in the world. And I like semi-passive and semi-active in the business. And I think
Mhm.
that fits for a lot of people. But people forget, they just assume they go through this play act as if the only thing they're supposed to do at some point they reach 50, 55,
Yep.
60, 65 is to sell. And what they forget is that what are they going to do with that time? If
Yeah.
you're going to sell, you need to have other passions and that really fill your soul, that feed you.
Right.
And most business owners, we don't have that. Our spouses do, but now we come back to our spouses and they look at us saying, well, where's that vibrant person I married, 37 years ago? What happened to him or her?
Yep. That's right. Yep. Yeah. And had one friend from a coaching thing he sold, and he didn't have his what's next. And the only thing he had is he'd go off to the coffee shop, get a coffee, and read the paper in the morning. That was the only routine that he had. He came back one morning, and his wife had locked him out of the house.
Well,
And they're still married to this day, so it has a happy ending. But she's like, look, you got to figure this out. Do not come back in here until you tell me what your plan is. And because she had her routine and he was disrupting it. But yeah, think about it. Even if you're selling a company for 5x, which is amazing, right? Could be walk away money if you've grown big enough. The other option is own it 5 years, right? And you still have the asset. And when and it's paying for your lifestyle and a lot of things. So me, I feel like I have more energy than I ever have. I've got a lot of unfinished business, and so all those private equity emails go into a folder, and I have no intention of acting on them, right?
So I've
But
got one last question for you, Kevin. First of all, I'm really appreciative of you sharing the time here. It's fun, this conversation. I think it's going to be quite useful for any business owner who's listening. If you had one last piece of advice to give to a business owner who says, look, can I really continue to grow this business? Can I really continue to make it more and more independent of me? Is it really worth doing? Can I do it? Is really the doubt that they have. They feel like they've hit a plateau. what would you share with that business owner?
Yeah, actually, probably two things. One, get great business coaching. I think looking back in mind, that's the difference between someone making, $500,000 in their business and making millions, right? And make sure you're getting coached by someone that's actually done it, right? There's some not great coaching, but the other is, I'm gonna have to defer to Peter Drucker on this. Is the number one thing that a leader has to do is manage their time and really focusing on that. And with our clients, we do something called the profit time index, where we're looking at what's their all-in time on the business, in the business, on the business, and then how much operating profit are they generating, and what's that yield on their time. They're not billing by the hour, but your time has value. And in Robert Slee, those that are into the private capital market stuff, he calls this the V ladder. But really, as Peter Drucker says, being super intentional on your time. And that means a number of things. Assemble that team around you. All right. If you don't have an assistant, get one yesterday. That's one of the first things to do. Get that stuff off your plate so that you're only working on the highest yield activities. And the more I've focused on that, the more my, business owners I know and clients I know focus on that, the better they do. And sometimes you have to be really militant on that. I have it. So I don't even have access to the software. I cannot physically prepare a tax return now, even my own, right? I had to put that boundary in because I'm one, I can get sucked down that rabbit hole like anybody. But guess what? If I do that, I've now taken my time down under $300 an hour. Bad idea. I need to be working on the $10,000 an hour stuff. So that would be the other big tip.
I think it's fantastic, Kevin. Thank you so much for taking time out of your day, talking about how valuable time is. You've just touched the lives of a lot of business people, and it makes a difference. Thank you for all you do.
My pleasure, and thanks you. Appreciate the friendship. Take care.